Good morning and welcome to Stock Market Today. It's Monday, October 7th, 2019. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today, where you can sign up for a free email. Get daily stock ideas for you to consider in your inbox every trading day before the market opens. So let's get right back to it. Monday morning. Hope everybody had a great weekend. U.S. equities finished higher in Friday's trading near the best levels of the day, though the S&P 500 ended with a third straight week of losses. Treasuries were stronger with the curve flattening. The dollar was weaker versus the euro and the yen. Gold was down 10 basis points on the day Friday. WTI crude rallied 70 basis points, breaking an 8-day streak of declines. Your outperforming sectors: financials, technology, healthcare, staples, and utilities. Your underperformers were materials, REITs, energy, and consumer discretionary. And now, as we get to the desk this morning, S&P 500 futures are giving a little bit back, down 20 basis points, extending the decline from last week, where we did, as I said, finish lower for a third consecutive week. Europe and Asia were mostly higher overnight, though China and Hong Kong were both closed. Treasuries are a bit weaker here this morning after last week's big rally. The dollar is weaker versus the yen and the euro. Gold down 40 basis points, and WTI trying to make it two in a row here, up 1.4% after breaking that 8-day streak of declines on Friday. As we look at the S&P 500, to me, the big news is that we closed the gap, right? That gap that opened up on Wednesday morning, we closed that as two-way volatility becomes a near-term theme in the marketplace. Key support is now at the 200-day moving average near 28.40, call it 28.41, and will likely continue to move higher. Then at the August lows near 28.20. Now, resistance comes into play in the area between 29.50 and 3,000. Now, we closed at 29.52 on Friday, but we do have some weakness in the marketplace here this morning. RSI bounced with the market to hold the 40 level. That is important. And we'll also highlight, and we'll see this throughout the show, a lot of the charts that we look at, the pullback over the past week and a half or so did not produce an oversold level. So from an indicator standpoint, that is somewhat of a positive if we can quickly regain our footing and move to the upside. At the same time, for the S&P 500, Chaikin money flow is bullish. And after those 2 days of closes near the high of the day, that gave us a nice little uptick over the past 2 days in Chaikin money flow. So the indicators are okay. Market holding above support for now. Do expect two-way volatility, right? October, historically a positive month on average, but also known for volatility. And I think that, we can use volatility to our advantage as long as certain parameters, such as these key support levels that we're highlighting here, continue to hold. Taking a look at our market in a minute. Quick highlights from my note to Chaikin Analytics clients today. We hit on the first one already. SPY closes the gap from Wednesday morning. That is important. Small caps continue to underperform large caps, but I do think they're nearing an inflection point. We'll take a look at that a little bit later in the show. Gold begins to move higher in its consolidation. That's been an ongoing bullish theme for us. Treasury yields drop as investors seek safety. That's another ongoing theme for us. We'll take a look at the 10-year here now as it's nearing support. And as we said, futures do point to a slightly lower open here today. Taking a look at the power bars. After Friday's rally across the board, Dow adds 1.37%, but still skewed in favor of the bears. 6 bearish stocks for 3 bullish stocks. S&P 1.3% to the good, but still skewed for the bears. 96 to 84. NASDAQ slight outperformer on the day. Thank you, Apple. 18 bullish or very bullish stocks for 22 bearish or very bearish stocks. Small caps were up on the day, but again, notice the underperformance. Up 93 basis points, while the broader averages were all up about 1.3% on the day. Bonds rallied, sending yields lower. We've been touching on that for a while, but what's interesting to me is this big rally in the financials in the face of falling yields on Friday. Financials fundamentals still look okay. 13 bullish or very bullish stocks for 4 bearish or very bearish stocks. Just looking for financials to gain some traction when it comes to relative performance. So according to the Chaikin Power Bar, small cap stocks somewhat more bullish than large cap stocks. Major markets across the board are mixed. Our stock of the day, speaking of financials, comes to us from that group. Synovus SNVS is the ticker symbol. It comes to us from the Banks and Thrifts Industry Group. Has a very bullish Chaikin Power Gauge rating due to very strong earnings performance, attractive financial metrics, and strong price volume activity. So when we take the 20 factors, there are 5 in each of these 4 major categories, we come out with a very bullish rating. And that's what generates the stock of the day. Algorithm generates it based on that bullish rating. We have a strong trend with the stock above the long-term trend line, and the industry group is strong from a power bar perspective. However, market and model not in agreement at this time. We have the very bullish rating, yes, but the stock is still an underperformer relative to the S&P 500. The key when we're looking for bullish ideas is to find the very bullish and bullish stocks that are outperforming the market. When the market and model are in agreement, that greatly increases your odds of continued outperformance. Stock is oversold based on our overbought, oversold indicator. Chaikin money flow is mixed. To me, what do we do with a name like Synovus now that it's on our screen? We add it to a bullish watch list, right? There's enough here to keep us interested. Right. And if all else remains the same, if the rating remains bullish or very bullish, money flow remains, or picks back up, trend remains strong, and then this stock starts to outperform, then it becomes a lot more interesting, in my opinion. Never a bad opportunity to add names to a bullish watch list, especially with the back and forth volatility that we've seen, right? Doing nothing is sometimes the right choice, and you can take advantage of that time by looking for names that have potential to do well when the market stabilizes and begins to turn higher. I highly, highly advocate for establishing and maintaining bullish and bearish watch lists. Add Synovus to a bullish watch list here today. Taking a look at our sector tracker now, the movement over the last 5 days for the major sectors. Nice to see tech at the top of the list. Slowing growth based on the economic data we're seeing leads investors to growth areas of the market like technology, and tech outperformed last week. Healthcare, a bit of a defensive feel to it. Staples, defensive. Comms, a little bit of a rebound. Real estate and utilities round out the list of names that are positive over the past 5 days. So still very much a defensive feel. For those of you who have been following my work for a while, you know I have this view of the market that in a slowing growth environment, we want to favor growth as well as the defensives and the yield plays. That still remains the case, and that theme largely played out last week. Discretionary fins and materials, middle of the road. Industrials lower on the back of that weaker economic data, and energy just continues to be an area of the market that we want to avoid. Stay away from it on the long side of the portfolio. Look for opportunities on the bearish side if you trade that way. Oil continues to retreat. It is nearing a support level, but continues to retreat. But aside from that, the fundamentals based on our model within the energy complex still remain bearish, and therefore we want to continue to avoid that group. Our industry in focus today is another one that you probably want to stay away from for the time being. Transportation services. Over the past 6 months, this subsector has underperformed the S&P 500 by 7.83%. And the power bar ratio, which measures future potential, hints at more to come. Why is that? 13 bearish or very bearish stocks for 8 bullish or very bullish stocks, right? Earns the group a rank of number 16 of 21 subsectors, and it's moved down 5 slots over the past week. So some of the indicative names within this group that you want to avoid on the long side or potentially look for bearish opportunities if you do trade that way. Old Dominion, ODFL, has a very bearish rating. Macquarie Infrastructure, MIC, has a very bearish rating. And UNP, Union Pacific, has a very bearish rating at Chaikin Analytics. And when we take a look at the XTN, the fund that measures the transports, it's a bit mixed with a bearish skew is how I'd view it, right? Because the power gauge rating is neutral, but the trend is weak with the fund below and now declining long-term trend line. For all intents and purposes, right, we just have some choppy sideways trading. Very similar to what we've seen in small caps, to be perfectly honest. But what does that mean? That means the group has been underperforming the SPY for the better part of the past 12 months. Chaikin money flow is bearish, with the intensity of that bearishness picking up of late. Now, the fund is oversold, so I wouldn't be surprised to potentially see a near-term bounce, but it's hard to get excited about the transports based on everything we're seeing here. Neutral rating, underperforming, bearish money flow below the trend line. I just can't get there. on the transports. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. Friday, rather. Semis were strong. Also, the news of Apple increasing production sent Skyworks higher by 4.37%. Nectar just continues two-way volatility. No real news, up 4.2%. CB didn't see any real news to drive that stock higher by better than 3.5% on the day. TMO made an acquisition in Ireland, a site in Ireland a couple of days ago. That sent that stock higher by 3.3%. ConAgra, CAG, higher by a little bit more than 3%. Nothing company specific there. We're going to start to get in a little bit of a news vacuum for stocks on an individual basis in front of earnings, which start to really kick off in earnest next week. Hewlett-Packard leads the losers as they announce a restructuring. APA, just energy weakness continues to weigh on that stock. CTVA, still too new for us to rate. Didn't see any real news, down 3.68%. ULTA, caught a neutral initiation at Goldman Sachs. Stock lower by 2.65%, but I will highlight that Jim Cramer gave it a positive mention on Friday afternoon. Align, no real news on Friday to send that stock lower by 1.7%, but I did see that it caught a downgrade here this morning. Let's dive into the charts now. Small caps lag, but near a possible turning point or an inflection point, if you will. We're taking a look at the ratio of the IWM, the Russell 2000 ETF, to the S&P 500 ETF SPY, and we can see a clear downtrend since last summer, below a declining 200-day moving average as small cap stocks have underperformed their large cap peers, right? That's nothing new. We've been talking about that for a very long time, and we've been highlighting opportunities and the fact that we prefer large caps over small caps, and this chart is largely the reason why. But what's interesting to me is now, as we sit here, as we test the lows, we actually have a higher low for the RSI, so the potential for a bullish divergence in relative performance for the IWM coinciding with the fund itself on an absolute basis testing support at the 145 to 150 level. So small caps are certainly at an inflection point. If they can hold here at the 145 level, and if this positive divergence leads to a reversal in this trend, we can start to think about coming back to the small caps and looking for opportunities within the small cap space. We're not there yet, but I want to highlight it as early as possible and I want everybody to see that there's a potential inflection point at play in small caps. Remember, we update our thoughts, our views every day as the facts change. There's potential for facts to be changing here for the small caps. Let's keep an eye on this one closely. The 10-year yield is also nearing support. Here we are, right? Clear downtrend below the 50-day moving average, below the 200-day moving average for the yields. This means prices of the treasuries are moving higher. However, here as well, we are nearing support and have the potential for a positive divergence as the RSI is marking a potentially higher low after routinely becoming oversold, right? Is that a sign to run out and change our view? Absolutely not, but it is a sign of a potential change afoot from a momentum perspective. That's exactly what it is. We'd look for, if we could see the yield start to stabilize around 1.5%, begin to build a base and move higher as momentum shifts with it, we'd probably have to start to rethink our view on treasuries. Not going to do that just yet, but starting to lay the groundwork for what we could potentially see to get us to change that view. For now, path of least resistance remains lower for treasuries. What is that going to do? That's going to favor the bond proxies within the equity market. Think about your REITs, think about your utilities, continue to look for opportunities there when they present themselves, but just be mindful of what's happening to 10-year yields as they near support. Finally, if oil is going to bounce, this would be the spot. All right, WTI, here's the spike after the attack on the Saudi oil field, right? Quickly reverses and pulls back to test support in the $50 to $52 range. And what's interesting to me, I said we were going to start to talk about divergences. Here's the third one in a row across major themes that we watch on a daily basis. Notice that as the RSI makes higher lows, the fund is not making, or the crude oil rather, is not making lower lows. It's holding support. So potential here for a momentum shift in crude oil should this divergence play out and we get a reversal higher, we'd want to start to think about this downtrend line in energy being broken. Again, not there yet, but I watch these relationships and these themes on an ongoing basis to try to alert you to them and shift our view as quickly as possible. That's going to wrap it up for today. Head over to chaikinanalytics.com/today to sign up for that email. I'll be back here tomorrow. Have a great Monday, everyone.